RCAT. Yeah, it's a fascinating company, but also incredibly risky. It's a key player in the drone technology space, operating in aerospace and defense. They integrate pretty advanced hardware and software solutions, things like the Teal Drone's Black Widow system and their new FANG FPV drones. These are for military and also commercial use. It's a really exciting sector, no doubt. But yeah, this one's currently loaded with some extreme financial risk.
Absolutely. You can feel the tension there. The central question for us today, I think, is whether RCAT's explosive market growth potential and its strategic positioning within that massive defense pipeline, a government-backed industry, whether that justifies its really extreme valuation metrics. Or do those metrics, combined with serious concerns about sustained profitability and, frankly, shareholder dilution, prove the stock is just fundamentally too speculative right now?
Yeah, and I'll be taking the position that the raw financial data, especially the severe and ongoing dilution of shareholders, it just renders the stock highly speculative and, well, significantly overvalued against pretty much any rational measure of current production or intrinsic value.
And I'll argue the other side, that the growth narrative, the strategic validation they've achieved through critical military certifications and their mission-critical technology position, well, these outweigh the short-term negative profitability, which, is often a necessary evil for companies in this kind of aggressive high-barrier scaling phase. So my view is that RCAT is fundamentally a technology play. It's benefiting from these massive global defense spending tailwinds. And if you just look at the stock performance itself, you kind of see the market's verdict there. 291.23% growth over a single year and an extraordinary, almost unbelievable 648.32% surge over 3 years. So traditional metrics like negative profitability, they become almost irrelevant in the near term because the market is clearly buying the future here, the long-term value creation potential.
That performance, I'd argue, is purely speculative froth. It seems divorced from reality, driven more by announcements and hype than actual, dollars coming in the door.
Well, I disagree because I think that growth is rooted in tangible strategic strengths and validated technology. Look at the Teal Drone's Black Widow system. It's achieved critical military validation. We see evidence of that with its formal approval for the NATO NSPA Catalog. That's significant. Furthermore, the company achieved the globally recognized AS 9100 certification for aerospace manufacturing. Now, that certification alone is a major hurdle, a huge barrier to entry for new defense contractors. This isn't just hype. This is real strategic validation that potentially unlocks massive future contracts.
Okay, it certifies their factory processes, yes, but not necessarily their capacity to actually deliver profit for shareholders. That's a different thing.
But these certifications are what unlock the revenue potential. And we're already seeing the growth trajectories start to manifest in the financials. Sales year over year on a trailing 12 months basis TTM grew significantly at 49.84%, almost 50%. And RCAT is simultaneously expanding its capabilities. They've launched the specialized FANG line of FPV drones specifically for defense, and they've established a dedicated maritime division, Blue Ops Inc., to pursue uncrewed surface vessels. And crucially, their balance sheet looks pretty clean right now. A quick ratio of 3.12, current ratio of 3.80, and incredibly low long-term debt to equity at just 0.02. They have built a strong capital base to fund this necessary development and capture that market share.
Okay, I have to challenge that positive spin you put on the balance sheet strength. While, yes, the ratios look good on the surface, that strong capital base only exists because the company is constantly tapping the market for cash. That 49.84% growth rate in TTM sales, it sounds impressive, but it's a percentage built on a really minuscule base number. And it's completely overshadowed by the firm's massive sustained unprofitability. The stock fundamentally is just mispriced and deeply speculative.
Okay, what evidence are you pointing to specifically for that level of mispricing?
Well, we see it clearly in the valuation models. If we run, say, a discounted cash flow analysis, which tries to estimate the intrinsic value based on future earnings potential, the result suggests the true value is somewhere around $3.95 per share. That implies the current market price is overvalued by over 60%. I mean, despite all the high-profile news in the military nods, TTTM sales are a paltry $16.47 million, yet the market cap stands at $1.32 billion. This leads to an utterly extreme price-to-sales ratio, the PS, approaching 80, and an enterprise value to sales of 77.22. These are huge numbers.
But those are snapshots of where they are today, not where they're headed.
They are current realities that define the required trajectory. The TTM income is negative $38.31 million. The company is generating just dreadful operating and profit margins. Operating margin is negative 159.80%. Profit margin is negative 232.64%. I mean, this financial crisis is precisely what forces them into these constant damaging capital raises, which massively dilute shareholder value. We've seen multiple large public offerings in 2025 alone. A big one, $150 million in September, $46.75 million back in June, and $30 million in April. And critics are even raising concerns over the company's reliance on, potentially high-risk financing tools, maybe even toxic death spiral convertible notes. This is high-risk capital formation driven entirely by an inability to achieve operational self-sufficiency yet. A PS ratio approaching 80, it suggests the market isn't just pricing in future potential, it feels like it's pricing in decades of perfect, flawless execution and a scaling of revenue by orders of magnitude that simply hasn't materialized. We have a $1.32 billion valuation built on just $16.47 million in TTM sales. How do you rationalize this extreme disconnect against that staggering $38.31 million loss?
These metrics, I think, reflect the company in that critical hyper-growth scaling phase. They're trying to capture a defense market that is projected to reach, $47 billion by 2032? You just can't compare these ratios directly to a mature industrial firm. It doesn't work. The market is valuing the intellectual property, the AS9100 manufacturing standard, which is crucial, and the future sales pipeline that stems from potentially massive government contracts, not just the last 12 months of revenue. Furthermore, those public offerings, which, yes, you critique as dilution, they also built that strong cash position, 0.56 cash per share. This ensures they survive long enough to actually monetize these strategic assets, like the FANG line and the Black Widow system, which are now validated components in the defense ecosystem. Survival is paramount for a company at this stage.
If the story were truly this validated and the potential so inevitable, wouldn't analyst sentiment be more universally positive? The commentary wouldn't be so wary. Jim Cramer, for instance, he's repeatedly noted the fundamental concern. The company is simply not making any money. And furthermore, the stock carries high volatility. You see that with a beta of 1.26 and a really substantial short interest hovering near 23% of the float. That high short interest, to me, is the strongest indicator of institutional skepticism. Sophisticated money managers are actively betting against this valuation narrative, precisely because of the underlying financial fragility.
Analyst skepticism is, it's natural for disruptive growth, especially in a volatile sector like defense tech. But we shouldn't just dismiss the experts who specialize here. The company has received strong votes of confidence from key sector analysts. We see a $17 target price from Needham, an outperform rating with a $15 target from Northland. And this optimism, I believe, is tied directly to the positive news flow and the strategic relevance, specifically things like the recent partnership announcements with Redwire and Safe Pro Group for AI integration and new strategic drone concepts. These are really key integration points for modernizing the military, which arguably provides a layer of stability that the current financials might lack.
That's a compelling point regarding the analysts and partnerships, I grant you that. But have you considered the actions of the insiders themselves? I mean, management knows the true operational and financial state of the firm better than any external analyst, right? And we see pretty pervasive insider selling throughout late 2024 and into 2025. By the CEO, the CFO, the CTO, directors, often right after exercising options. For instance, CEO Jeffrey Thompson and Director Christopher Moe were involved in significant sales and proposed sales just in September 2025 alone. If the long-term potential of this company is truly worth $1.32 billion, Why is the management team consistently selling millions of dollars worth of their shares? That speaks volumes about their own confidence, regardless of what the press releases say.
Okay, insider transactions are complex. They're often driven by personal liquidity needs, maybe diversification after options vesting, especially considering the stock's massive run-up. That's not entirely unusual. And the key mitigating factor, I think, is that insider ownership remains substantial, around 17.06%. What is far more concerning to the core narrative, perhaps more than routine sales, is the external noise and the legal overhang. The company is currently facing securities fraud lawsuits. These allege it materially overstated production capacity at its Salt Lake City facility and maybe inflated the value of the U.S. Army SSR contract. Now, these legal risks, which directly challenge the core operational claims and the perceived size of its government pipeline, those are the main threat to the stock price narrative right now, perhaps even more so than the negative TTM profit margin, which, let's face it, everyone already knows about and accepts as part of the current phase.
I would argue the legal issues and the financial issues are really two sides of the same coin. It's about credibility. If the entire market capitalization relies on these projected massive revenues for military contracts that are supposed to justify that near 80 PS ratio, and then you have major lawsuits alleging the company misrepresented its capacity to fulfill those very contracts, well then the valuation risk is just exponentially magnified. That combination of financial hemorrhage and serious legal doubt is, well, it's a highly toxic mix for investors.
Look, RCAT Holdings is strategically positioned. It's in a rapidly accelerating government-backed defense market. While short-term metrics like a PS ratio near 80 might look alarming, especially to a strict value investor, the almost 50% TTM sales growth combined with critical military certifications like the NATO NSPA Catalog approval and, yes, a strong liquidity profile built through those capital raises, it argues for patient capital. This company represents a necessary, albeit maybe early-stage investment in the future of national security technology, and its valuation reflects the scarcity premium for truly certified U.S.-based defense drone solutions right now.
In my analysis, well, it starts from a completely different base. While the strategic position is undeniably strong in theory, the financial reality on the ground remains severely problematic. Investors are currently absorbing massive losses in unprecedented levels of dilution, while key insiders are actively monetizing their positions. The combination of sustained negative profitability, extreme valuation models showing potentially over 60% downside, and these securities fraud allegations regarding core business claims, it just means the risk profile, in my view, far outweighs the speculative reward, regardless of how strong the industry tailwinds might appear. Financial discipline has to matter eventually.